Now, one interesting thing that I have learned as we jumped up to this larger property is that the financing is all different. And, the things like the acquisition's basically the same. The value add is basically the same. It's the same tools. It may be more units, but it's basically the same. The one thing that has been noticeably different, in my opinion, has been the financing. And so when we're trying to borrow 19 or 20 million bucks versus 2 or 3 million bucks, now we're with, agencies and non-recourse debt as opposed to banking relationships and full recourse debt. And so it's been different. And one of the differences is that some like Fannie Mae or Freddie Mac, they all have their criteria, and sometimes they won't finance certain areas or certain markets, maybe because of crime or because of size or whatever. And we didn't realize that at the beginning. And so what it does, it makes it more difficult to finance, and it makes it more difficult to raise money.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Jay Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Ashley Garner. Ashley is a seasoned real estate entrepreneur and founder of ABG and Associates. With over 30 years of experience, he combines analytical rigor and hands-on property management to consistently deliver strong cash flowing returns to his investors. And in just a minute, we're going to speak with Ashley Garner about value add deal making, real world stories and lessons from transforming underperforming properties into profitable high yield investments. But first, if you like our show, CREPN Radio, there's a couple things you can do that helps out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Ashley Garner. Welcome to CREPN Radio.
Thank you, Darren. Glad to be here. Thanks for having me.
Well, I am. You're more than welcome, and I'm glad you're here, and certainly looking forward to our conversation. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure thing. Happy to. So I literally grew up in this business, and it was in a very hands-on way. So when I was in junior high and high school, that age, teenage years, my dad bought a lot of student rentals where they were old houses near a university campus, and we would internally subdivide them into multiple apartments and then rent them out to the students. And it grew to a good sized portfolio. And so I was literally with a hammer in my hand and doing the renovations and the repairs. And then I kind of worked my way up to the acquisitions, finance, legal, management, all that good stuff. And then when I kind of got a little bit older, I started buying some things on my own account, if you will. Went from the normal, I think what kind of is the normal route of single family, duplex, triplex. And then I liked it so much that I knew I wanted to do more. But the goals that I had financially were were large enough that I realized I was kind of mathematically eliminated from reaching my goals unless I somehow picked up the pace with the number of units. So I went to 10 units and then 32, then 35, and the most recent was a 196 unit property that we purchased just less than a year ago.
Awesome. Well, that's always unique, or I mean, it's always cool to hear, people's story and how they got into it, and for you to be literally hands-on and swinging hammers and that is a cool part of the story. I don't know that I have. I would say the majority of people I've spoken to about uh, flips and stuff, or not flips, but more of value add multifamily. That's not necessarily been the case. It's been more about capital investors and
Right.
underwriting and that type of stuff. So I would think that your investors would appreciate that you have that unique skill set. So that's
Yeah, I
cool.
think so. Yeah, I think so. I think that's something that sets us apart. You're right.
Yeah. So your or kind of what we keyed up to talk about was the value add in multifamily. It sounds like in the beginning with your dad, was it primarily just for your dad's portfolio, or was he working with investors, or how was that?
Yeah, no, initially it was kind of all him, and I think there are a few things that we had partners in, but it was mostly just him. And so, I think it was good and bad, that hands-on mentality that we had. It was good that I learned a ton of stuff. Like I have experience doing things you wouldn't believe. And I wouldn't have had that if it wasn't for, him saying, "Hey, Ash, we're going to go do this today. We're going to go dig this ditch, or we're going to go whatever." And now I had to kind of unlearn that as I wanted to scale, right? Because then you can't if you want to have that many units, there's very little hands-on stuff you can do yourself. And so I had to then become more of the manager of the folks that were doing all of the things. So it was interesting. It gave me a good perspective though, in order to be able to manage them effectively.
Well, and I was going to say, I would think that just having that experience, while it is, there is a real effort you have to make to separate yourself from actually doing the work, but to be able to recognize what you were being told as to whether or not it jived or made sense to with
Yeah,
what what you knew to be true,
right,
and
right.
so that's
Yeah,
that's
every once in a while I find myself reminding somebody that, like, "Hey, remember that I did this myself for like 20 years, right?" So I know exactly what you're talking about.
yeah, yeah.
Keep
So
everybody honest.
yeah, and so with that, you mentioned that you started buying your own, and what were the properties you were buying, and when was it that you made the decision to put down the tool belt?
Yeah. Well, like I said, so I grew up in that value add world with, hands-on physically. And so when I started on my own, that's exactly what I bought because that's what I knew. And single families to flip, and then duplexes, triplexes that I actually had to go, I every once in a while I'll drive by one, or my wife and I are together and we drive by one and I say, "Remember when I used to go down to that place, stay all night, painting the walls and sanding the floors?" And so that's what I did. And then when I got to the 10 unit place, that kind of pushed my limits. I had to, it was too much. So I had to bring in other people to help me, although I was there hands-on management. Now, then when I got the 32 unit, that's when it kind of changed for me because it was, number one, it was 2 hours away from my home, which was the first time that I had done that. And number two, it was just far too much work to do and manage. So that's when I really had to step back and start delegating all of the pieces.
Right. So in the conversion from the one and twos to the multiple units, 10 to 32, were you doing those solo, or had you started working with investors, or? How are
Yeah,
you?
so the
What's your
the 10 unit was solo, and I actually still own that. I bought that in 2013, and I'm tempted to sell it, but it's just too good of a place. The location's too good, and it's been a good like cash out refinance tool for me. But then when the 32 unit, I that was my first experience with bringing in a partner, and I thought initially that I would syndicate that, and I would get, you know, this is interesting. The scale is so interesting to me. This was back in 2018, and I needed to raise $350,000, and to me that might as well have been, 350 million at the time. Just my perspective. And I said, well, I think maybe I'll just go get 7 people and raise $50,000 a person, and that'll be my 350,000. Well, the first phone call I made was to a good friend, and I said, would you like to be involved in this? And blah blah blah. The answer was yes. And I said, well, how much do you want to do? And he's like, well, I guess if we do it, we'll just do it all. And it kind of blew my mind. Like, wait a minute, there's somebody willing to write a $350,000 check to come in and do business with me. So that was a real eye opener for me.
well, good choice on who to call first there. That's a
Yeah,
good
right.
that's good.
Yep.
So 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 you jumped from the smaller to the bigger. You mentioned your most recent acquisition was a what 192 units,
196. Yep.
196, and between the 30 and the 196, how many properties, and have you changed the structure from partners to syndication, or how are you doing it?
Yeah. So I'd say we have right around 300 units right now. And obviously the 196 is the majority of that. And our plan is to continue scaling, 200 units or more to kind of get to our initial goal of 1,000. So we're well on the way. But yeah, so the two most recent purchases were the syndication model. Um, and it's been great. We've learned so much, and we've brought in mostly it's friends, family, and previous clients. Yeah, I've been in the real estate business for a long, long time, so I feel like I've been blessed to have some great relationships, personal and business. So that's kind of my investor base so far. And of course, as you grow, when you're trying to raise 6, $8 million at a time, that's a lot of money. So we've had to kind of look at new ways to make new relationships with new investors.
Got it. So now that we know a little bit about your capital stack and how you've gone about acquiring the properties, let's talk about the strategy and the process and how you go about doing your value add.
Okay.
So when you're identifying a property, are there any key metrics or any, key things that you look for? I mean, does it have to be in a metro area of certain size? What are you looking for when you try and find and identify a property?
Yeah, so I think the very first thing that we're looking for is that the value that we would pay is justified by the current actual performance and not what it could do or what it should do or if I only re-rented all of the units at the same price that the owner just re-rented this one platinum unit, then it would be worth this. And so we don't play that game. And now there are exceptions, I guess, if it was half empty and like the 10 unit, for example, I bought that and unfortunately it was ended up to be 100% empty, but it needed to be because it was that much work that had to be done and it was in that bad of shape. But I knew the location would fill right back up, and it did. So that was like an exception. But uh, if we're able to underwrite it, and the value that we would pay is supported by what it's actually currently doing, then we know that we have lots of upside for value add. And the value add is not always swinging a hammer. For example, insurance. when we closed on the 196 unit, the day we closed, we added value because our insurance coverage was better coverage, but it was, a hundred and some $1,000s cheaper than the previous owner, which we used in the underwriting. So day one of closing, we put $100,000 on the bottom line on the NOI. And that's a pretty significant increase when you're looking at a property being valued based on the income. So that was pretty cool. But we wouldn't have had that opportunity had we, underwritten on the pro forma, so to speak.
Yeah. No, and that pro forma thing is real. And I guess it depends on the market. When the 192 unit, when did you, or 196 unit, when did you buy that one?
It was in February of last year, so we're like 10 months in or so.
Okay, so February 25.
Yep.
So yeah, that was it seems like historically, just in the looking back, that's a pretty good time to be in the acquisition mode based
Hmm.
on sellers or others financing expiring or whatever, or if they had a syndication and needing to get out, kind of
Right.
thing. And also, just with interest rates and stuff, doing what they've done, they probably were in some super, super low rate that maybe it had some bridge financing or whatever that
Hmm.
expired or whatever. But yeah, but no, I like your strategy on sticking with what is rather than accepting the pro forma, because a pro forma is if everything aligns,
Right.
uh, and like you said, insurance. The fact that the insurance was going down has not been the story here for the last 4 or 5 years.
True.
So good for you on that. Um, so we talked about, or you mentioned that the primary uh, way of underwriting is just that you use actual numbers. You're not going to go with any pro forma. Are there any other criteria? You mentioned that originally you were buying properties local, and then you stepped out, or stepped out of your circle there and went 2 hours
Right.
away. Is there any like territorial or are there just maybe not rules, but where you find that most of the properties, is there any common thread there as far as what you're looking
Yeah.
for when you're?
Yeah. So really, the one common thread is inside the state of North Carolina, and that's not, that doesn't mean that we don't look at things that are, in Virginia or South Carolina, but we know the state very well, like personally. Yeah, I've got family and friends and just about every part of the state, so I know it well. I can get to it well. I enjoy visiting there, but it doesn't have to be just in one state. But the investors that we raise money from, they want to invest in states like North Carolina because they the all of the factors are checked. All the boxes are checked when you're looking at a market that you would want to invest in. And since we know it, we say, well, we'll stick to right here. So that's been a common thread, and that will continue. We enjoy that. Other than that, it was where the numbers worked mostly. And, if I would kind of follow the spreadsheet. If the spreadsheet worked at this property here, then I would keep looking into it, and I'll keep looking into it, taking one more step each time until it doesn't work anymore. Now, one interesting thing that I have learned as we jumped up to this larger property is that the financing is all different. And, the things like the acquisition's basically the same. The value add is basically the same. It's the same tools. It may be more units, but it's basically the same. The one thing that has been noticeably different, in my opinion, has been the financing. And so when we're trying to borrow 19 or 20 million bucks versus 2 or 3 million bucks, now we're with, agencies and non-recourse debt as opposed to banking relationships and full recourse debt. And so it's been different. And one of the differences is that some like Fannie Mae or Freddie Mac, they all have their criteria, and sometimes they won't finance certain areas. or certain markets, maybe because of crime or because of size or whatever. And we didn't realize that at the beginning. And so what it does, it makes it more difficult to finance and it makes it more difficult to raise money. And those are things that we've noticed and we will factor in next time. Doesn't mean we wouldn't do it again. It just means we would know going in, like, okay, there's certain lenders that like this and certain that don't, as opposed to just thinking you can easily finance anything anywhere.
Yeah, can you be more specific on what you learned on the financing? Was it crime or was it or what was it that the
Yeah, so
agencies saw?
it could be any of it. Could be crime. Yes, that's definitely a factor, and that could be like such a micro thing as to be that specific location or that specific apartment complex. If there was a violent crime history there, then they could just say, you know what, we're not interested. We're not going to do it. Also, they could put a whole market or a whole town on this pre-review list and say, we're not interested in this county or this town because of it's a high military concentration or it's too small or whatever. And we didn't really realize that initially that it was that it could really affect things that much. And or they may say, oh yeah, we'll do it. The advertised max loan to value for a Fannie Mae loan is 80%, but in your market, because it has these factors, we're only going to loan you a maximum of 65%. Well, that just means you got to go out and raise that much more equity, which is already tough to do. So it makes doing the deal more difficult.
Yeah, no doubt. Especially if you're not thinking in those terms uh, before you start trying to raise money or you make an offer and that. So that that's
Right.
definitely some things that would be worth knowing.
Yeah.
So in the properties that you have, uh, would you describe them as are they the C properties, B properties, A properties? What are you finding as far as the and I suppose a lot of that has to do with age.
Yeah.
But can you describe some of the
I'd say we've got properties that range from C to B minus would be
okay?
would be what I would say. Um, One of the lessons again that we've learned is that there's certain investors or certain lenders that really would prefer it to be B plus or A minus or above, and uh, so we're just kind of we're taking all this in as we make our next move and say, okay, where do we want to be? Or at least if say, hey, if we buy this property in this market, then we know who our investor is, we know who our lender is. But if we go, downtown Charlotte with a 2015 built vintage property, then we have a different set of investors and a different financing options.
Got it. So based on the C and B minus, is that a particular vintage? What kind of year construction are we talking about?
So I've got properties right now that range from a 1960s built uh, up to a 19 like mid 1980s and then 2000s um, and even one in the 1970s. So all on the older side.
Okay. No. And with that, have you uh, is there anything that you've recognized from any one of those that you've kind of made note to self looking forward? You mentioned kind of dividing your investors, saying like these people only want to be in these types of properties. But is there anything that you've recognized that you've kind of put in the investment criteria going forward based on the different ages of construction you've acquired?
Yeah, for us, it seems like the ease of management is one of the biggest things that I notice. And the older properties tend to have much higher repair and maintenance costs because something's always breaking, or maybe they use different materials like galvanized pipes or aluminum wiring or whatever it is. And um, plus, not all of the utility meters are separated. And so then it makes it very difficult to bill back or, recoup the cost of your utilities. So that's just more hands-on management. So those are the kind of things that you have to, that's why the cap rates or that's why the prices are cheaper on those things, right? The risk is greater, it's harder, it's more work. And so I'm not going to pay you as much money for those as I maybe would for a newer place.
Right. Yeah, the capital improvements, if you're not ready for them, they're waiting for you. So,
Oh my gosh, yeah.
yeah. So tell me, kind of the theme of this is, how to make a profit.
Hmm.
So if you're looking at a property, the first thing that you mentioned was we underwrite using actual. You're not going to use the pro forma. Based on using the actual, are there any other, things that you recognize upfront in the underwriting process that uh, you know, help or influence your decision on how to offer or what to
Yeah.
offer?
Yeah, for sure. So, if we notice, if we're able to talk to insurance folks like you and know that we can get a better rate and like it's a lock something that we can count on, that's a big plus for us. Or if we notice things that are way out of whack, maybe payroll, uh, repairs, things like that, that we know that we just have so much experience that we know that we can manage some things better than possibly have been managed in the past. So that's something that we come in with confidence knowing. But again, that's what I want to buy it based on what it's doing today, knowing that my experience and the work that I'll do on the management side is something that now I can benefit from the added value. Like I don't want to pay the current owner for the work I'm about to do. I
Right.
want to get the benefit of that for myself.
Yeah, no, and I think depending on the marketplace, I know during COVID when interest rates were, under three
Mhm.
there was just a lot of interest in buying multifamily and lots of buyers and sellers were benefiting from that.
Yeah,
Things got a little out of hand as far as the ability to ask for more than or
sure.
to include the pro forma and then get into a bidding war just because people were trying to park some capital and stuff.
Yeah.
But no, I
Well, and
like
it's
your
tough. It's easy and it's tempting. It's very tempting when you're working on a spreadsheet to tweak a few things and now the numbers look really rosy. You could change an exit cap rate expectation by tiny
compress it.
amount
Yeah,
and it
yeah,
makes a huge difference. Or you could say, I think rents are going to increase 3 or 4% instead of 2%. Well, that makes a huge difference in your projections. And so then, or you might say, like you mentioned, hey, I'll buy it with this bridge debt at 3 or 4% or whatever, some crazy number, knowing that I can refinance in 5 years to the same thing. And now they can't. It's double. It's double what they had budgeted. And that's not a good feeling. That's a
yeah,
bad, scary feeling.
yeah. So with that, what kind of timelines do you and your investors look at? And when I say timelines, I mean obviously there's the underwriting and the acquisition, but more about the hold time. Do you have an exit planned, or are any of yours like you mentioned I think the 10 unit that you own personally that you've thought about selling, but it's a good little performer there.
Right.
Uh,
Yeah. So, my nature, and I know I inherited this from my dad because he didn't like to sell anything ever. But my personal nature is to buy and hold and keep. Just, it's hard to let go of something that pays you. Now, when we did the syndications, both of our syndications that we've done have been based on a 5-year business plan. And that's because, you have to set the expectation. It's not a promise, but it's an expectation of, hey, Darren, you put your money in here, don't expect it back any sooner than 5 years. Maybe I'll give it back, but it won't, but don't count on it. Plus, you have to have something to run base your returns on and things like that. However, again, there's a different type of investor and there's different types of financing. So, for instance, we are refinancing the 196 unit property to what's called a HUD 223F multifamily loan. And that has a 35-year amortization with a 35-year fixed interest rate. And, when you run the math on that, it blows your mind at what happens. It's almost like the parabolic, performance graph. But you've got to hold it past 10, 15 years in order to get the gigantic benefit. And we're also learning that there are plenty of investors that don't want the 5-year hold. They want a, 10, 20, or just an indefinite hold period. So far it's been a 5-year business plan on the syndications, but that may change.
Yeah, it's interesting to me. My wife and I, we invest and have a small portfolio, but my initial thought on real estate was if my tenant stays in there, long enough, they will pay off the loan
Yeah.
and it'll be a cash flow play.
Yeah.
And it's kind of like at the time, I was kind of thinking of like it's another 401k. Like,
Mhm.
how lucky am I? And and then also the tax benefits of depreciation, and obviously, those are for only so long. You got to recapitalize or get to something bigger. But still, just the basics. That was kind of my mindset, and
Mhm.
I feel like a lot of the syndication, uh, and I don't say the mindset, but just it's more like I could invest in your deal, or I could go buy this stock, or I could go, loan money over here. It's kind of an in and out uh, kind of
Mhm.
thing as opposed to a long range. It, when you are thinking or you're going through this refi, is that something that you kind of took the pulse on your investors to see if they were, you mentioned you recognize some people want to be in long term versus not. Is that something though that you went to your investors and approached them on, or is that just more
No,
of the management? You guys made the
yeah, we just
decision.
had that as a general partner. That's our responsibility. They came into the deal because they trusted us and they liked the property and our reputation. And so, but they also trusted us to make those types of decisions. The decision to go to that loan for us on this one was initially because it just was the best performance. The math was better doing that loan than it was doing any other loan. So it was all just strictly based on math. Um, However, I can definitely see a business strategy using long-term fixed rate financing like that as the play and attracting plenty of investors that way for sure. And we're not one other difference I think us versus others, and there's no right or wrong, it's just a different style. I'm not real big on creating a machine that has to operate on fees. I'm not here to close as many deals as I can close just so I can get the acquisition fee. I'm a real estate investor, and yes, we do take acquisition fees, but that's because we work our rear end off. So we've earned it. But the real play is the return on the actual investment itself.
Yeah. Um, one question I didn't ask, and we've kind of hinted at it. I mean, obviously, value add. You mentioned that it doesn't always have to be a capital improvement. It could
Yeah.
be as easy as finding better priced insurance. Um, is there any kind of an expectation as far as the amount of time to initiate uh, whatever the value add strategy is that you're? I mean, do you have a general rule of thumb like we need to have this in place, or let's try and get our value, recognized within? I mean, and I'm assuming it varies depending on what the value add strategy is, but can you speak to that at all as far as what your the different things you've had to do and the
Yeah.
time it's taken to recognize the value?
I think that it's definitely from my experience, it's dependent on each property because each property was kind of in different physical condition and different like ability to generate rents. The most recent acquisition, we're just kind of improving the units as they turn over. And that's because the occupancy is so good and the cash flow is already so good that there's no reason to go in and, you know, take 40 units offline and disrupt everything. We just turn them as we go. I mentioned the 10 unit place. It was in such bad shape that the only way to fix it was to literally get everyone out and basically gut it and start over. And so, that was a totally different situation. Um, I don't, sometimes the capital improvements are limited by how much money you've got. If you don't have enough capital set aside to spend on the improvements, then you kind of have to wait until you build up enough cash. Sometimes it's that limitation.
Yeah. No, and I kind of I sense that as we've been talking, it's each one of those situations is kind of a new lesson you learn that
Oh yeah.
not to or how to avoid or how to navigate it the next
Yeah.
time you see it. So that's good.
A buddy of mine, I was talking to him last night and he said, hey, Ash, you know what the definition of an entrepreneur is, don't you? And I knew he was setting me up for, I said, no, what is it? And he said, you jump out of the airplane and you build your parachute on the way down. And I said, well, that's just exactly about right, I'd say.
Yeah. Well, and but with that, you're I would guess that more often than not, you have some sort of a sense of where you want to land
Oh,
or
yeah,
some sort of direction, and whether or not you have all the experience to get there, you've got enough MacGyver sense or whatever you want to call it,
exactly.
to
Yeah,
recognize that, what you can or how you can, or at least some initiative to try and ask the next question or make something work.
that's right.
And, and,
And
uh,
the relationships of the people to ask, I am far, far from the smartest person in any room, but I know a lot of people who can answer the questions that I need to have answered. And relationships are paramount. They're huge. They're everything. And so I'm not afraid to call and ask for help, ask for advice, just hear other people talk, and I take all that into account and try to make a success out of it.
no, definitely. Hey, Ashley, if we could, I'd like to shift gears here for a second.
Okay.
Um, as I mentioned to you before, by day I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And
Hmm.
there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's
Okay.
not an option, we look to see if there's a way we can minimize the risk. And if we can't avoid nor minimize the risk, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be your clients, investors, the Fed, municipalities, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer.
Okay.
And so if you're willing, I'd like to ask you, Ashley Garner, what is the biggest risk?
I think the biggest risk is to be undercapitalized and and ultimately, a property can go up in value or the P&L can show a profit, but if you don't have enough cash flow to pay the bills or make the repairs that you need to make or make the improvements you need to make, then you're in a tight spot and that puts everything at risk. And that's an avoidable risk to not be undercapitalized, but the temptation is so great a lot of times to say, I'm going to just manage this myself and save that money. Or I'm going to turn units out of operations. I'm going to use the money from operations to improve units. And then unfortunately, then a water leak happens or something happens and you need to do 10 at once. Well, you don't have enough money to do 10 at once, and now you can't rent them and you're in trouble. And so, but if you've got a nice reserve pile of cash, so to speak, then you may not enjoy spending it all right now, but you can, and you can stay online and you can survive. So being without enough capital is 100%, in my opinion, the biggest risk. And I know that's not necessarily an insurance thing, but I know you didn't ask for just an insurance. I do have a physical risk that is my number one, but the undercapitalization is my biggest risk.
Yeah, what's your physical risk?
Water, just water in general, whether it's from the rain or the wind or from, here's a great story. So I had a tenant one time. This was in the 32 unit place. And these are 4 2-story buildings, fabulous, all brick. They're wonderful, but they're 4 on the bottom, 4 on the top. And so this was a service member, and he had spent a lot of time in Japan, being stationed in Japan. Well, and he got hooked on the bidets that they had on the toilets in Japan. So when he moved back to the United States, he rented one of our apartments on the 2nd floor, and he decided he would install a bidet on the toilet all by himself. And so he did that, and then he went out of town for the weekend, and evidently he didn't do it right, and the thing busted and just sprayed water for like 2 days. And, it just caused, I don't know, like $60,000, $70,000 worth of damage. So now I'm faced with, do I pay it out of pocket or do I file the claim knowing the insurance company is going to drop me if I do it? So that was not fun. And since then, we've put into place some different policies with, renter insurance policies and, things like that. But that was a tough one.
Yeah. No, water, if it's not in its natural, if it's not contained, it's a problem. So no, that's good. That's good. Well, and the bidet thing, again, lesson learned there. Make sure your tenants have insurance, right? That's the
yeah, right.
Right.
Yes, indeed, indeed.
Good. Hey, Ashley, where can the listeners go if they'd like to learn more or connect with you?
Yeah, sure. I think the easiest way is probably our website, which is abgmultifamily.com. And from there, you can do things like sign up for our investment club or our newsletter, or our email address is on there. And we're pretty well represented on YouTube and LinkedIn and all the socials as well. But the website will get you to all of that stuff.
Got it. Well, Ashley Garner, I cannot say thanks enough for taking the time to talk. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Yeah, Darren, I've enjoyed it too, and I appreciate the opportunity.
You got it.
Right.
For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.